So let me get rid of this real quick. So today what we're going to do, we're just going to basically talk about adding structure to what we do. Having the type of structure that we need in order to be able to make trading a little bit simpler, right? Now, obviously, we know that the key to getting better at this is, working on yourself from the inner part, right? And then things, as you're doing this, it starts to get better. Things starts to become clear. One of the things I like to say is it's almost if the universe is uncovering blind spots, on your eyes, like it's like uplifting your lids. So what I want to talk about is, I know everybody watching this video might not be fully acclimated into everything that we do. So I'm gonna keep it pretty much simple, but it's gonna be able to really highlight the significance of it. So my mindset when I'm approaching the charts, our mindset when we're approaching the charts is we don't want to be reactionary, right? We don't want to be reactionary when we're approaching the charts, because in the retail world, when you're talking about when we're dealing with retail concepts and retail habits, it's all about being reactionary. The FOMO kicks in, the fear of missing out, the fear of losing, right? The over leveraging, the over trading, right? All of that stuff comes in. That's why when we program ourselves in a different program, saying stuff repeatedly, the market never leaves without us, stuff like that. That is to soothe that fear of missing out technique. So when we're looking at the market, the most important thing you want to be focusing on is the higher time frame story. Now, when we talk about smart money, right, when we're talking about the banks and the people who move the market, so their interest is going to be on these higher time frames. So what I do is I call these three charts right here my bank charts: the daily, the weekly, and the monthly. Okay. And the reason why is because, think about it. If the whole game of the market is pairing orders, which is pairing liquidity, like that's how the market moves up and down, either sellers looking for buyers or buyers looking for sellers, right? Sellers looking to exit or buyers looking to exit, sellers looking to enter or buyers looking to enter, right? So if that's what moves the market, the pairing of orders, right? Then at the end of the day, the people who basically trade, right, just like how we do, all of these people grow, some of these people do it as a career, and they're the people who manage these financial institutions, these hedge funds, these trading floors. They're people just like us. So my 90% of these people still go manage more money with their retail mindsets, right? You got people who trade methods based off time. You have people who trade methods based off systems, time-based systems, indicator-based systems, like all of that different type of stuff. And what matters is the people who doing their business on these higher time frame charts, the daily, weekly, and monthly, those are the people who's actually controlling the flow of the market, or that's where the interest of liquidity will be for the people who want to get there to be able to pair their orders up with people who have their interests at these higher time frame levels. So one of my rules is I have a couple different range concepts, and we teach those in our course. But to a really, really simple approach to dignifying higher time frame price action is, what I like to do is I like to look at least the last 3 months of price action, right? I look at the last 3 months of price action and kind of pretty much allow that to give me my range, because our goal is to trap the market. Like a lot of times the methods that we used to doing is, it causes us to do stuff like go all the way back here, pitch support and resist, like all of that stuff, like it's just a distraction. You want to know what's actually going on technically, and then so you can use the few fundamental things that we learn, right, to be able to system what we see on the chart, right? Seasonalities, commitments of traders, open interest, right? All of that different type of stuff. So what we want to do is trap the market. So what I would do is, this would be my monthly low, right? This would be my monthly low, and this will obviously be my monthly high. And what that does, if I was to go back down to the daily chart, it gives me a range, right? You can pretty much see this high, and you can pretty much see this low. It gives me a range to be able to trap price, so I can pay attention to the price action that's going on in this range rather than trying to focus on stuff all the way back from 1976. So what we want to do is then when we go, if we went to our weekly chart, we can pretty much take the same concept. So what I'm trying to do is overall, I'm keeping in my mindset the order flow of the market. The order flow is basically the direction, right? Is the market pulling down into levels and then making new higher highs, right? Are they accumulating, right, areas of imbalance, right, where we have no price action, right? And then that's resulting in, you know, accumulation after it touches that level, right? So that's what order flow is. We want to be following the order flow. So we obviously can see the order flow on the monthly is bullish because starting from this point down here, right, we had the market, right, make a clear high here, right? We had another higher high here, higher low, right? And then we had the market now trapped in this price range right here. So we can see all of this bullishness that was pushing the market up, and we can see obviously the order flow is bullish. But then you have to look, I want to teach you guys something. When you're looking at price action, you're always going to have a long-term bias, a intermediate term bias, and a short-term bias. So the same thing when you're looking at corrections and expansions, right? So this is an expansion. So what we're looking at is we have immediate price action that's going to be more on a short-term basis, right? And usually you have, let me write this out. You have higher highs, higher lows, lower lows, and lower highs. But what about highs and just plain lows? Make that a capital L, right? So let me keep that over there. You pretty much get what I'm saying. So look, so higher high, higher low, lower low, lower high. Obviously that's uptrend and downtrend. But what about highs and lows? Because technically, if we're looking at this price action, right, on the monthly chart, this is your higher low, right? And this would be your higher high. But as you can see, price also had a monthly low here, right? That price violated. It violated this sell to buy, right? It violated that price, right? And then obviously price started correcting back into that level. And this is short-term price action. So what we would do is actually put this back up here. What we'd be looking at is on this weekly chart, right? Price made a lower low, right? So we have a weekly. One second. We have a weekly lower low right there made because this low, right? Well, this low is lower than this low. So that's a lower low, right? In essence, right? So what we have to pay attention to is now that we have that higher time frame structure, like our overall structure is formed as higher high, higher low, lower low, and lower high, we also can look at our high and low structure, right? And we'll continue doing it as we go down to the daily. So if you peep out, now we have even a smaller range. Obviously, we have our whole monthly range here, right? But then we was able to even trap the market more by focusing on this price action in here. And obviously, we know we have our monthly liquidity above here, which means to be monthly orders above there, right? We have weekly liquidity below this. See this W, this big double bottom, right? So we know we have weekly liquidity below there. So these weekly, monthly, daily levels do what we do call drawing on price. These levels are going to draw price in, right? They're going to be drawn like a magnet. These higher time frame levels, as I told you guys at the beginning, these are the bank levels. So what do you think the market does to monthly liquidity? It's drawn towards it, right? Because they want to pair their orders. If they're buying, they're offering buy side liquidity. So they want to pair their interests to exit buys and make money and take profit, but they need somebody to take the other side of the order if they're going to exit their buys. So they're going to run it up here to this buy side liquidity. Obviously, you don't have to go up there, but these with these higher time frame levels, how these higher time frame levels are look like. So we know it's a bigger chance if the market was going up, right? You asking yourself, what do you think the actual market is going to? We're not trying to guess, but if we're anticipating, right? we got monthly liquidity here. The market will be drawn to this level. Just like how this weekly liquidity, we see this big W. We know retail likes to trade W's. We know retail likes to do W's and double bottoms, right? So this is weekly liquidity. So if the market was to start coming down towards here, what is the chance that they won't come pair their orders up with this liquidity below here? Because on the weekly chart, institutions, hedge funds, people with money, retail traders on all different levels, investors, they're all buying, right, in all of this, right? The market sold to buy, right? That means people are in buy profit, right? So it's buy profit. So you got sell side orders, liquidity below here. So when they're offering sell side liquidity, meaning pushing the market down, if they need to exit their sales, right? Basically, because you can't make money until you take profit, right? So if they need to exit their sales, they need to find somebody to take the other side of that trade to basically exit. They need to sell it back to somebody, right? So they're going to sell it to these sellers, which is sell side liquidity in the form of stop losses, right? And different stuff like that that's under the market. So that's how they get, that's what pairing liquidity is. We need to exit our sales. So in order to exit, we need to sell our orders, our positions back. And then they're going to make the people who losing buy their positions back, right? Which is a stop loss. And that's how you get taken out. Every order is a pairing of orders. And that's how the market is ran, right? So it's a lot, you know, it's more than that, obviously. And we go over it in detail in our boot camp that we have, our full course that we have. We teach everything about how to, you know, read these different signs and stuff, right? So if we are looking at this being a weekly level for potential liquidity, then we can keep that in mind. So now what happens when we go down to, now that we're down on our daily chart, right? We have our own price action that's on the daily chart. And what I immediately see is price here, right, made a higher high, right, on the daily. So I will mark this. So I will be looking at price action like this, right? Daily higher high. So price made a higher high right there on the daily chart. So in all essence, this would be the higher low. But there's no need to mark this off at the daily high and low because we have this weekly structure right here that we can just use as the origin point. Now, what we can do is this is the higher high, this is the higher low. But what do we have here? We have a daily low. Remember, as we talk, let's move this over here now. We have a daily low. Remember, higher high, higher low, lower high, high and low. So we have a daily low, right? Let me just put it right here. So what I do is, see, I got daily low, right? Not a higher low or lower low, just a daily low. Because this is the higher low, this is the higher high, because price traded higher than this price action to the left. It made a higher, this high is higher than this last high. And this low is higher than this last low. So this is a higher low, right? And a higher high. But this is a low because price sold to buy. We have price close above the open of this down candle right here. So they made that a fractal low, right? So that's a daily low, right? Just like how we got this daily higher high. So it'll be the same essence. What do you think is above here? It's daily liquidity, right? Daily stops below here, right? The structure points at. So remember, this is the lowest bank time frame, right? And this is the time frame I use the most because after you get your higher time frame structure points like this, and even if you did like, you know, marking off the middle points, like areas like that, where you can just round them off like to levels like that, right? It's still all to be, you know, when you get down to your daily chart, it'll be the most nearest price action. So look at this as your lower time bank chart. I mean, your lower bank chart, your middle bank chart, and your higher bank chart. So the daily is going to give you the most action, obviously, and that's going to be the one you're going to be using to determine the flow, right? The weekly and the monthly, I'm really just using for looking for areas that they're going to be interested into pushing the market to, or holding the market or trapping the market around these levels. You get what I'm saying? They either trap the market, go to these levels, or trap the market around these levels. Basically, you know, put the daily and 4 hours into situations like this. You get what I'm saying? So what we want to do is we want to pay attention to is, let's go back to over here. Let's move this down a little bit so we won't lose this, because we want to keep this. I want you guys to pay attention to this. Remember, high, 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 low, lower, low, lower, high, high, and low. I want you guys to drop me some 7s in the chat if you following everything that I'm saying so far, guys. Let me know that y'all, so I can know if I need to go back over a few things. So, and I'm gonna have, you'll get the recording of this too for you guys that's already in our group. So the daily low and the daily higher high, right? So what we're gonna do next is, now we have our midterm charts, because our whole system is based off time and price. And time isn't just the time on the clock, right? It's time frame, right, as price action. So the market is fractal. It's broken down fractally, meaning the same thing that happens on, yes. So let me read that one more time. Could you go over why you called it the daily low and not a higher low? Because in all essence, brother, think about it. This was the high, right? And price broke it. So this made this a higher high. So in all terminology, this would be the higher low here. But there's already a weekly structure here. You get what I'm saying? So now you have this is what's just a daily low. It's not lower than this low, and this isn't higher than this high. So it can't be it can't be a higher low, right? So what it is just a flat out low. And what it basically is just the middle point of this range, of this high and this low. See, it's just the 50% of this. Did that make more sense, bro? And 9 times out of 10, that's what it's going to be. It's going to be around the 50% of a range, and it's just going to be another higher low in the middle of an actual range. Did that make more sense, bro? So you can use your Fibonacci's too to look for that equilibrium point, and usually you'll get it to line up just exactly how it did, and you'll see a ton of more examples for that. Okay, so what we're gonna do is, now we're gonna talk about the 1 hour, the 4 hour chart, and the 15-minute chart, right? You can add the, obviously you can use the 15 and the 30-minute chart in cahoots with each other. Like you can just combine those two, but we're just gonna say 15-minute chart, okay? So the 4 hour, the 1 hour, and the 15-minute chart is gonna be your lower time frame, higher time frame charts. I hope that makes sense. This is gonna be your lower time frame, higher time frame charts. So meaning that this is meaning that after you have these higher time frame levels, these are the charts that, I mean, these are the time frames that you're looking for the accumulation and distribution. Because I want to tell you guys something, the banks, the people who run the market, we teach that they use they allow the market to pull back on the 4 hour, 1 hour, and 15-minute, correct, just for the purpose of manipulation and drawing people into the market. They use these lower time frames in to entice people, to create you know, FOMO and different things like that, give people patterns, give people bull flags at a premium, right? We're trading into something like this and they set bull flags here and people get slammed, right? So what we look at is, these are our lower time frame, higher time frame charts, meaning that I won't even consider a trade unless it's coming off a 1 hour or 4 hour level. And then I go down to using the 15 as that lowest lower time frame, higher, and nothing less than that. And I'm gonna show you guys exactly what I mean. That's why I'm doing this step by step. I'm gonna exactly see how we come to the conclusion of basically doing this. So what's going to help you with all of this is, you see this, this is going to add to this low point and this 50% point. This imbalance candle right here, a lot of times I know people are doing the imbalances, you know, marking off the imbalance, but everything is structured. We don't do zones. Like nothing we do is a zone. It's specific levels, right? So the three important parts of the imbalance, right? Like where we get that less price action is the open of it, the middle of it, and the close of it. Nothing is zones. We don't trade supply and demand, right? We don't trade supply and demand zones. So we're not doing zones, we're doing specific price levels. That's why we pay attention to the right side of the scale. And we tell you guys to pay attention to the institutional levels of 20, 50, 80, and full figure, right? And then we do the quarter points in between, because these gives us specific levels, right? And if you look up here, it obviously tell you where the open, right, is at, where the close is at, and you can use your Fibonacci from open to close to find the middle of that, which is like here, right? But we would have converted it to that middle of this whole range. So what's important is we use specific levels. So in order to get the precision that we get to be snipers, right, you have to use specific structure levels. We're not doing zones. That's how people end up with stupid crazy drawdown and 30 pip stop losses and only going for 40, 50 pips, right? The average in the retail world is 1 to 2, 1 to 3, 1 to 1. Our average minimum is 1 to 5, all the way up to 1 to whatever you want to do. We do 1 to 100s, 1 to 50s, 1 to 75s, 1 to 20s, 1 to 10s, right? It's all about what the market is showing you at the time. But 1 to 3 is not professional trading. Like, that is just doing too much work. And it's because of the lack of information that people have, why they think that that's the end all, because they spent $1,000 on a course or whatever they did, right? But what's actually professional trading is managing your risk, risking a little bit to make a whole lot. 1 to 5 risk is 5%. If you had $100,000 account and you risk 1% and made 5%, that's $5,000. But let's talk about some of our 1 to 20s. That's 20%. That's 20K, right? We do, like a week ago, I literally was catching Euro USD like for the whole week, like up and down and up. And it was like multiple positions, 1 to 14s, 1 to 16s. So that's what professional trading is, okay? So what we want to talk about is, now that we got our daily structure, real quick, let me go back. One thing that I like to do on a daily time frame, if I want to kind of like encapsulate a little bit more of this range, I use a concept. Let me pull this over here. I use a concept of, obviously it's all about trapping the market. So I always want to have an idea of how I'm arranging it. So what I do is, from the day that the market is at, I look back 20 days to the left. And what that does for me is, in my mind, the algorithm that we talk about that runs the market, that runs price, right, is always looking back 20 days in the previous price action to see where orders are stacked in the market, right? So if you counted back 20 days from today, right, which is the 20th, that will pitch you back to obviously the first, right, which would be here. So you would just have to calibrate that to the nearest low, which that would make this the lowest low in the last 20 days. So if we put a horizontal line right here, right, this is the lowest low in the last 20 days. So this is short-term. This is the short-term daily range, right, of price action. And if we went back 20 more days behind this, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 20, right? That will put us around this point. This would be the 40-day, looking back in price and looking at levels. What this does for us is, we know that majority of people who trade do intraday trading, right? So the algorithm is always looking back in order to get forward. That's why we call it looking left to get right, right? We're always looking left to get right. We have to use the price action on the left side of the chart to look right. So what this does is, it's showing you how to trap the market. If you only had this to pay attention to, it would lessen your choices and your reactionary trading that you usually do. Because now you can start pointing out institutional points like the liquidity on the daily, right? The institutional candle here, right? The liquidity below here, the institutional candle here, the imbalance here. And it makes it simple. So you're like, okay, I have my higher time frame institutional reference points. Now I can just wait for the market to trade to and for or from these levels, right? The game is about 10% buying, 10% selling, 80% waiting, because the market never leaves without us. So let me get rid of some of this. So how we're approaching the market is very, very specific, and it's why we call it obviously smart money, because everything everybody else is doing, not to belittle people or anything, but it's dumb money. It's like, it is what it is. It ain't about feelings. It's like, you get your fucking counter blown, like, who cares? Like, you obviously not doing something right if it's consistently happening. Everybody blows accounts, but when it eventually, it becomes because of the lack of information, not just because you're going through the growing pains, So let's continue on. So let's say, for instance, we were approaching this level, right, and pretty much looking at this imbalances 50% level as a potential opportunity for price to buy up. And what we would do is, I want to just erase like up into this point. So when the market is here, right, you're looking for where the discount price, where the discount, right? So if the market accumulates at a discount, the price, we're going to look for price to go up into a premium, which will be looking at the left side of the chart and finding higher price, right? We've seen price came lower. This was a swing low on the daily. I mean, a swing down on the daily, right? So that's going to be our swing down price action. So we're going to be looking for points of interest in this area where we saw manipulations, where we saw people get trapped, where we saw all of those different type of things, right? So, so what we want to do is we want to find those areas of manipulation, areas of imbalance, and all of that different type of stuff, right? So my methodology is I never look at anything. I never approach the market, and I'm now going to show you how I pretty much approach the market. And obviously, it might going to seem like it's really simple, but you know, with practice and with all of that stuff, you're going to be able to do the same thing. You know, you help enough people, and you keep teaching this to enough people, and you study enough, and that's the secret to getting better at this. Not just studying 10 hours a day or studying 8 hours a day. You got to teach people what you know. You got to help people what you know. Do as much as you can in the universe. That's going to be the result of the value that you're giving, is you becoming a consistent trader, a professional trader, you know, hitting positions in your business and your company and stuff like that. Everybody gets it backwards. They always say stuff like, you know what, I'm trying to focus on my trading and this, and you have to realize that we didn't get to where we at by doing that. Even when we didn't have money, even when we didn't know everything, we were still doing videos every single day, trainings every single day to teach whatever we did know. And that's the result of the chairman. That's the result of the consistency. A lot of people tend to want to go in a hole and think like, oh, I just need to learn. I need to learn. Like, you're not going to get results from that. Because you're only looking for results for yourself, you know. So you got to get out of the mindset that you don't know enough or you don't have enough, because that's not an excuse. Like, we made no money, no consistency, nothing. We still taught everything that we can every single day, right? So I just want to say that real quick. So when we're looking at price, what I like to do is I'm finding initially my higher time frame structure, right? And then I'm looking for the accumulation and distribution based off my fractal system of, you know, which time frames I look at. So in this case, with this being this would be a daily discount, right? A daily institutional discount. I will be looking for 1 or 2 time frames below that daily at the 4 hour or the 1 hour, looking for accumulation away from that level. So if we look for at the 1 hour chart, right? I'm waiting for accumulation. Now, what is accumulation and distribution in a quick, funky way? I'll give it to you. This is distribution, right? And this is accumulation. Okay? Like, that's just in a nice, funky way, you know, break a structure, right, to the high side, and break a structure to the low side. That's accumulation, that's distribution, okay? And in the boot camp, obviously, we go into way more details about different ways that you can figure that out. So what we have here is this. We have a daily low, okay? And this is 1 or 2 time frames lower than its initial structure point. Daily structure point, the 4 hour will be 1 time frame lower, and the 1 hour will be 2 time frames lower. We can use either or, but usually now I'm just going to the second time frame because I'm getting that crispy point of interest and stuff. So daily structure, 1 hour accumulation. Okay. So what I'm doing is I'm waiting for the accumulation to happen on the daily chart, and we get it here, right? You see price trades down into that level. Price breaks their structure here. So we have accumulation off this higher time frame level on 1 and 2 time frames lower than the structure level. We got the accumulation, right? So now what I do, my next step I do is I mark that I figure out that lower time frame, reference point, right? And we could be using this whole structure point, all of this, market moving here, selling before the buying, or we could be using this little imbalance that's in here. As you can see, we have this low and then this middle point. So you got this imbalance right here, right? Because it's inside of this, selling before the buying. So you got this imbalance here that we could be using, right? So let me get rid of this, right? So what happens is my third step is I'm looking at time. I'm making sure time matches up with the currency that I'm trading is like, and you have to pay attention to what you're trading, because if you're trading certain things, I know sometimes I don't only trade in London and New York, but if I'm looking at stuff like Euro JPY and New Zealand and stuff like that, I also have to be aware that based off the currency that it is, the Asian session can heavily affect those currency pairs also. So you have to be setting alerts and paying attention even in Asian session when you're trading certain pairs. But with Euro USD, this is basically a London and New York moving pair, right? So I'm gonna be paying attention to this from any time between 12 Eastern midnight and 12 Eastern afternoon. So unless it's like FOMC news or something like that later in the day. So what we're gonna do now is we have our lower time frame point, right? Our point of interest. So we paid attention to the time. The time is after that 12 o'clock mark. 0000 indicates 12 o'clock on based off how I'm looking at it. So this is the 12 o'clock mark, right? So anything after 12 o'clock, I'm looking for potential accumulation from this area. So you have two choices. I'm going to show you two ways. What we can do first is we can either enter, right, based off either the high, the midpoint, or the low of this point of interest. So let's, for instance, we use the middle, right? We could just enter off that, right? And I would go down to the 15-minute chart to find an actual structure point, like below here, or below this little structure right here. Basically, this little up move right here. Because, the 1 hour is just big candle. So I just go where I can just find a structure to put my stop loss on. So it'd be like right below there. And that's how I pretty much set up this trade, right? And target-wise, I'm gonna show you this way, and then I'm gonna show you the second way that you can approach this. This would be the conservative way, like the really conservative way. It's a little bit more risk, right? You're pretty much, it's 1 step, 2 step, 3 step, you're getting in. So as far as targets, right? So if we're entering off a daily structure low based off around this daily structure level, I'm at least be looking for price to get up to a daily premium, or we could be using a 4-hour premium to be conservative, right? We can have this 4-hour high marked off here, right? And if we went down to like the 15-minute chart over here, you can see where the manipulation was done at around the structure point. You can pretty much see this this M and then the manipulation there. So what I would do is I mark off these up 2 candles right here to indicate that manipulation, right? Where they took the orders before they went down, right? So that's our point of interest, that 4-hour point of interest. So what we can do is we can use that as a target. So we can start looking to the right side of our scale to make it make sense. So at the mean threshold, we got the 135. If we want to sweep the highs, we can go for the 145, or we can go for 118.50, because that's the midpoint level. Or if you want to take it into this zone, you can go for 118 like 35 or 118.30, right? So at 118.30, that's a 1 to 6, right? At 118.35, it's a 1 to 6.5. At 118.50, right, that's a 1 to 7.5, right? So on a 100K account, right, risking 1%, that's $7,000. 0.5%, that's 3,500, right? So that's pretty much how you approach it that way. Now, let's say, for instance, we were wanting to try to attempt to get a even more precise entry. So what I would do is I would restart the whole shebang of what I did at this level. So I would use this one of these lower time frame levels as my new structure point. Well, actually, we can use the 15-minute in this case because we have the 15-minute point of interest. So now that would be my higher time frame structure. So now I'm gonna look for 1 or 2 time frames below, right? And this time I can use the 1 minute also, but 3-minute, 5-minute chart, I can look for accumulation in that level. So let's go to the 3-minute chart, right? On the 3-minute chart, you can see price hits this level. So if we didn't want to buy it, basically, we didn't just want to buy it when it was trading down to this level. We wanted to wait for more evidence, okay? And this is how we can tighten up our risk to reward. Because pay attention, the highest risk to reward that we had on that last trade was a 1-7. And basically with 100K, right, on a 1% risk, that's oops, sorry about that. That's $7,000 profit. Okay. So we're going to keep that over there just to keep that in mind. And that was like going for those stops at that 50 level. So let's see what changes about that. And we're going to target the same levels. So the 15-minute institutional reference point is our higher time frame. Lower is our lower higher time frame structure now. Remember I told you about the 4-hour, 1 hour, and 15-minute. So now we're on the 3-minute chart looking for accumulation. You can see we get it here. We have price make a swing lower and then price expands up, right? We have the selling before the buying. We have the buying before the selling here, where we can see that structure was taken out, right? And then we have price. So this would have been our new, I can get rid of this now, but this would have been our new area point of interest that we're looking at. This whole sell move down right before this buying up. So now what we can do is we do the same thing over. We can be entering at this point of interest because we got the accumulation off of the higher time frame structure. So we can enter at that point of interest. We put our stop loss, we'll show you. So let's say we took a long here at the top of this, right? Then we had our stop loss below this low, right? That's about 6 pips. Okay, so now we're going to use the same targets, okay? We're going to use the same, we're going to aim for the same targets. So if we went up here to this for the 35 level, that's already a 1 to 11, right? Or 1 to 10.5, 1 to 10.5, okay? If we went for that 50 level, right, to sweep this liquidity up here, the daily liquidity, that would be a 1 to 13, basically 1 to 12, 80, call it a 1 to 13. So let's put those numbers in now. So a 1 to 12, oops. We had a 1 to 12, and then we had a 1 to 10, right? So that drastically changes those numbers to $12,000 and $10,000 on a 1% risk on a 100K account, right? Same trade. We didn't even need to catch it at the low here. We actually caught it up here, but the risk to reward was even better. Nothing matters but the R&R. If the R&R makes sense, then everything else makes sense. And that's pretty much how you will be able to get even a more sniper entry. And you see how we turned that 1 to 7 to, yes, using the lower time frames to refine and execute. So we turned that 1 to 7, right, which would have been a 1 to 7 up here, to now a 1 to 13. We get to actually, remember, even coming to here is a 1 to 9.5. That's better than that first trade that take profit was all the way up here by just buying it once it hit there. Like you see the power in that? That's a 1 to 10 right here. That's 10K. You risk 1%, right? If you risk 1% on this trade on $100,000, you'd have just made $10,000, right? I don't want to make any income claims or anything, but you know, we obviously wouldn't be teaching this stuff if people are not doing it. It takes you a half a day to make 10K. Okay, day trade, really simple target, right? And every time, this is what we're doing over and over and over again. And then when you add the few other things that we learn about, you know, the fundamental things like, you know, using other assets against each other, you know, to be real brief about that. Like that's why you see commodities, bonds. So then we're looking at bond prices, we're looking at yield prices, we're looking at commodity prices to you know, test them against each other, because we know how the market works is when dollar is going up, gold and stuff is going down. right? When dollar is doing certain things, it should affect the commodity prices a certain way. When commodities is doing a certain thing, it should affect the bond prices. When certain things are happening, it should affect the yield prices, the open interest, the treasury notes, the indexes, the future market, right? All the actual, base currency. So all of that stuff is in a market analysis. Now, just imagine being able to put together, and it's not a lot. We do minimum fundamental work. But just imagine being able to put those things together and like has it as a crutch to help you. So I want to show you guys an example before we get off here. I'm gonna erase all of this. I want to show you guys an example of how I was able to use fundamentals and price action to basically do what I do. I'm gonna go try to find this. I'm gonna try to find this picture I picked. USD. Boom. Here we go. I knew it's gonna pop right up. So I want to play this to you guys, right? I want you guys to pay attention to this, and I'm gonna show you how we use fundamentals and everything to catch a weekly trade on USD. So pay attention. So what we were looking at was the commitment of traders. And basically, if you read what I put, I say, I see EU having a nice move up this week potentially. We had SMT between Euro USD and DXY occur yesterday, which means that when the dollar attempted to make a lower low, right, Euro USD failed to do, the opposite or whatever. So we had an SMT between Euro USD and DXY occur yesterday, plus CLT on Euro USD started increasing on Euro futures. So the commitment of traders, as you can see, when it was at that support, oh my God. But when it was at that support, you can see how it was showing that increase in open interest. I mean, not an open interest, in the commitment of traders, right? Open interest was actually declining. So what I did was, let me actually go back to what that buy was at. I want to say it was up in, it was like up in here. Yeah, it was here. It was right here. So let's play. I just wanted to show you guys the proof first, so you wouldn't like think that I'm like fibbing or anything. But that was we had the CLT going up, and this is when price was obviously all the way down here. When price was here is when I sent this, right? We're seeing all of the signs like lining up, right? So let's go back and look at to what we had on that price action. So what I was looking at was we had a daily structure right here, right? A daily structure low, right? So I had that pretty much marked out like this, right? And then when I went down to the 4-hour chart, right, I seen the accumulation here on the 4-hour chart, right? You can see it. Well, let me just use an arrow to make it simple. See the accumulation here, right? Yes, this was the high, right? The higher, the lower high, and this was the lower low, but price made a fractal high and then made a higher high, right? So this became the accumulation on the 4-hour chart, and then you have this 4-hour POI, right? You can pretty much see, I waited for accumulation there, right? We got price come create a low. Or if you went to the line chart, you have to go to the line chart to see it. You can see it broke the lows, right? So we had price splash up above that little structure that it was making down there in this expansion, and it touched this. Let me give you guys this real quick, because we got about 15 more minutes, and then we're gonna jump off of this. I'm gonna let you guys ask some questions. Pretty much want to go for about 45 minutes. What I want you guys to pay attention to is this. When you see this previous low, this previous high like this, even though price didn't break it, right? This still is an established fractal high. So price, oh my God, bro, come on, man. Price actually has to trade up. If price trade up into that level, even without it breaking, it still established a new fractal high, right? With price making a lower a lower candle on the right and a lower candle on the left, fractal high. So this still can be looked at as a fractal low, because you have to imagine right? This is what I want you to do. Let's get rid of this so you can imagine with me. Imagine me, right? So you have to imagine as if this structure was actually broken. Where would the original, it'd be down here, right? We'd be looking like, okay, this is a broke structure. This is what the selling before the buying started. So we use that same concept, right? So we had the structure touch, and only the rules to that is it has to touch into this point of, this buying to sell up here, right? It can't be like in order to look at this as a potential fractal low, because we already seen the accumulation on a higher time frame chart. We're just trying to get in sync now. So after that, when I seen that, I basically had, like I say, this marked off like this, right? Long, right here, right? Use this structure right here, or even if you to use, I'll show you what I used. I used this structure. Oops, that was like weird. I used this structure here, okay? But you could have even used this structure, and you could have used below the bodies of this, right? Basically at, let me show you, like where it closes at, put it like a little bit below that. And what I was targeting was this structure point, right? And on the 1 hour, right, I wanted it to run above here. So I we had the 118.50, right? It was targeting. So this was pretty much the setup. Like, this is pretty much like the setup like this. So I had two positions on that. I had a position here, I caught a position here. I ended up getting like 1 to 20, like 25% out of this whole trade, like out of this position and in the position that I put over here. So I ended up getting like 25% on that. Like, I mean, the wonders it did to my account was crazy. I actually made my biggest withdrawal of the year off this trade right here. And that was just using, in a week before that, right? I caught the sale down. I caught the sale from here. Remember, I got all of these screenshots and stuff on if you go on my Instagram, you can see them in my highlights. But we caught the sale from up here, right? To down here, right? For that liquidity below there. Like, so we sold it 1, 2, 3. I got out about right here, right? So that wasn't risk to reward. I'm just showing you the setup. But this, I sold it from this point. I literally sold it from this point here to all the way down here, and then brought it from here to all the way up here, right? Using price action and a few little fundamental things, like some of the things that I showed you right here, using intermarket analysis, like comparing other things like dollar against this, right? And that gave off the setup. So if you take anything out of this training, the most important thing I want you to take out of this training is everything starts with structure. So let me show you how, got about 10 more minutes now. Let me show you how, even on the intraday basis, how you can just use the 1 hour time frame. Actually, you can get this back normal. Using the 1 hour time frame, how it will basically, even intraday trading, or some people call it scalping, right? Whatever you want to call it. But even intraday trading, using these 1 hour levels, how powerful it can be if you actually wait. Okay. So let's say, for instance, right? Let's go back on. Let's get rid of that. So I just don't want y'all paying attention to that over there. So we're going to break down this sale here. Like, obviously, originally, we knew this was a 4 hour structure level, but we're going to use it 4 hour or 1 hour, either or. We're seeing the fractal high, and then we're seeing price. You want me to give you, how could I forget this? So look, so when you're looking at picking structure points, I told you guys, like, oh, we want to use this as a structure point. How you pick the perfect, and I don't really like to say perfect when it comes to Forex, but as far as this, it is a perfect way to do this. Like, it's a perfect way to do your fibs. You either put it from the high to the low, or the body to the body. Like, it ain't no other way. So this is the perfect way to identify structure points. So you see this, that's distribution, right? So that's your 1 hour structure point, right? Because you got 1 hour distribution. So that's the 1 hour structure point. Remember, structure is first, structure is king. Structure shows you that the banks are actually participating in the market. These structure breaks show that they're putting orders, they're putting footprints in the market. So how to identify good structure points is looking for that distribution and then considering that the structure, right? Because at that point, right, we can identify this is the 1 hour, this would be the 1 hour like structure high. And so if I went down to the 15-minute chart, and we can look for the same thing. I pretty much get, I'm looking for distribution on this chart. So I pretty much get my distribution here, right? We get the distribution off that level. And so that makes this our point of interest, right? So we can be shorting either at the low, the mean threshold, or above, you know, at that rejection area, which is, you know, where basically where the body stops, or shorting at that rejection area. So, or if you want to, obviously, if you're anticipating, sometimes ways, times when the market will trade above here a little bit more and come back down. And sometimes if you take a trade here, you might get stopped out. But if the market trades above here and then comes back down and does it again, you still can attempt to take that trade back again as long as you get another structure break, right, on the appropriate time frames. So let me get rid of this real quick. I don't know why they're always doing that. Right, so over here, what you're going to be paying attention to is you could have got short. You could have got short at this mean threshold of this area, or just the middle of this, you know, point of interest. You could have got short there. You could have put your stop loss above this high over here, right? It's about 8.5 pips, 8.5 pips. That could have been your stop loss, and you could have been targeting. Since we've been talking about the 1 hour chart, you could have been targeting a 1 hour structure low here just to get below this liquidity, this W, this 1 hour low here. Go down to the 5-minute chart. You can see this 5-minute POI, or obviously you have the liquidity that's below this low. Okay, so in that case, we will be able to target, you know, this low. That's a 1 to 5.5. Even this low right here, it's about 1 to 4.7. So that's about a 1 to 5, right? And if you went for the lows, the liquidity that gives you about a 1 to 6, right? And then if we went, obviously, if we wanted to get even a more sniper entry, that's available, how I showed you guys earlier. But this would just be catching a conservative entry, 1 to 6, or if you wanted to use this 15-minute, let's get rid of this. We got the 15-minute point of interest. So we had a low, pretty much made, because remember what I was just telling you about, we see it broken down over here. So we got the low made, price come touch this last place was sold to buy. So we could have been looking at this as the high, right? This basically would have been, you know, like the range between this high and this low. And on the 1-minute chart, if you put a Fibonacci from the low to the high, you can pretty much see that's the equilibrium of this range, right there. So what you could have been doing, you could have been just using this point of interest, this little up candle right here, right? Because it's right at the middle. You could just been using that as a point of interest. So we would have price, we found another structure point, price came down. We could have been sellers at the bottom of this level. Our stop loss will go above the high, right? 5 pip stop loss. Same target. Let's put this out. Same target. Look at that, 1 to 7. We went for the lows. So 1 to 9, right? Small stop, big lot. So if you had, let's say for instance, we're going to say something hypothetically. If you had $10,000 in your account and you were going to risk, let's say 1%, and your stop loss is only 5 pips, that allows you to be able to, that allows you to be able to use the lot size of, you can use 2 lots, right? Because 1% is $1,000 on 100K. I mean, I'm tripping. You use 20 cent. I mean, it's not 100K. I said 10K. So you use 20 cent. You use a 20 cent lot on this trade. You better use a 20 cent lot, right? Small stop, big lot. And because your risk amount will only be $100 if you're only risking 100%. I mean, 1% of 10K is $100. So $20 times 5 is $100, right? So that's how that math is done. So that look, that's pretty much easy. That's a 1 to 9 right there, right? And this is just an intraday trade for 1 hour premium to 1 hour discount, right? Waiting for the same concepts to take place to be able to do the thing. And we do another training another day to talk about how to manage trades, because obviously a lot of people experience getting stopped out and stuff like that. So we'll talk about how to manage trades, because I do it really, really specifically. You know, I took a couple things I learned from other people, then I have my way to do it, you know, certain things that I do. So with that said, guys, if you guys have any questions, you can drop the questions now. I hope you guys got value from this. If you're watching the replay on this, you always can reach out to me on Instagram at Modest Phillips. You can reach out to me. You can reach out to our team at Tradehouse, California, on YouTube, Instagram, Facebook. Either or. We do have a free group. All the information to be inside of the comment section. And I appreciate you guys jumping in to pretty much listen to this knowledge and stuff. So talk to me. You guys enjoyed? Did you guys learn something? Did you guys have some what do you call it? Paradigm shifts with how, you know, to approach the market and actually what you're actually waiting for. Yeah. And this is where you want to get to. You want to get to the point to where the market becomes so abundantly in competence for you that you are able to do this within minutes. Like if I had this chart blank, I don't know why they would never want to let me do it. But if I had this chart blank, right, it takes me maybe 4 to 5 minutes to find my levels, find a structure, right? And this would be obviously because during the weekend I do certain work, so I can have certain ideas for direction, like some of the stuff that I was talking about, like commitment to traders, commodities, and stuff like that. I look at all of that stuff during the weekend and maybe a few times throughout the week, but not a lot, maybe once or twice. But and it helps me with my idea for directional bias. Then I just wait for price action to line up with it, right? But technicals is king. Technicals over fundamentals, to me at least. But when it lines up, it works perfect. So what I do is I can come right to the daily chart, weekly chart. I can boom, 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 find my range, right? I come down, boom, 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 find the equilibriums of those ranges, find all my institutional reference points, right? And wait for price to trade to them. Once price get to them, I know the exact time frames to look at and what I'm looking for on those time frames, and I know how to approach the area when it gets there. And then I know what to wait on if I want to wait for more information, right? Even to the point to where if I get stopped out, I know what to look for me either to participate in something else later in a little bit later time to go in that direction, maybe an hour, 30 minutes, 4 hours next session or something, or to either recognize if I got stopped out and the trade is actually still valid to catch some potential buys or sales in the direction that you got stopped out on. Basically, you got tried to take a sale, got stopped out, right? Something like, you know, you took a sale, and this is perfect right here. Like, we're not gonna talk about the reason, which you're gonna say hypothetically, but for whatever reason you took a sale here. I can teach you real quick, just real quick, take 2 minutes. So whatever reason you took a sale here, you obviously got stopped out. You see this candle, well, we have to go to a lower time, go to one time frame lower. You see this candle. You see this candle that was used to take the liquidity out, this up candle right here. See how this up candle was the one you used to break, to take out, you know, that would have stopped you out. Obviously, if you had your stop, if you took a short, maybe just as your setup, your idea. I wouldn't have took this setup because look at the time. It's like early Asian session, like that's caca. But let's say, for instance, for whatever reason, you was looking at this as your, you know, structure break by the sale. You was like, I'm gonna take a short and target, you know, you're trying to target down here somewhere. You took that short and then you get stopped out there. You see this specific, and this is this specific candle. You want to find the actual candle or two candles, or no more than three. But this specific candle right here is the one that took out this high. You can see it started here, opened here, it closed here. That's the one that took out the high. Yeah, all of this happened afterwards, but this is the candle that did it, right? So what you can do is, if you see the market close back below the open of this candle, then that's looked at as a stop point. So now I can wait for the market to give me the correct structure to potentially take another sale to continue this short, right? So did that make sense? If you're trading London time, if you're trading London, what time do you look for your setups? Or do you look for them on Sunday when markets open and wait for them to play out during the week? I usually by the time I get done marking on my daily and 4 hour levels, they're probably going to be there for a while. The only levels I'm continuously adjusting is really the 1 hour and the 15-minute levels, but I don't even pit 15-minute levels on my chart. I don't pit nothing lower than 1 hour levels. Now, if the 1 hour levels already accumulated, then I'll go down to the 15-minute chart and look for structures on the 15-minute chart. But everything minimally starts with the 1 hour, right? The 1 hour structure. Okay, so because that's the lowest. This is the lowest one, but just trust me when I tell you that the 1 hour is the lowest time frame you want to look at as for actual support and resistance in the market. Now, once the 1 hour is established, then you can use the 15-minute chart for structure points also. So what I would do is I would already have those levels marked up, and then when time comes about, like London session, or if we got some news or whatever the case might be, then I will wait for the market to trade to those levels, right? And then I execute. So like, say for instance, maybe this was a 1 hour structure. Well, we were looking at this, but say for instance, this was a 1 hour structure we were looking at, right? And price, we were waiting for price to, well, we had the 1 hour structure, and on the 15-minute, we had the buying and sell right here. Obviously, that took this liquidity out. Obviously, it started here, right? Including that candle that took the liquidity out. So we could have been waiting for, if I was waiting for this, see, at 7 a.m. in the morning, that's my New York open time. So this would be an excellent trade for me. So 1 hour structure, right? We got the break, we got the 15-minute distribution, right? So this can be a short, right? Have your stop loss above here be about 18 pips for me. I will go down to the 5-minute chart and find like a better structure than that, because it wouldn't be recalled to have it that low. So I would take this in balance, right? And I would probably put my stop loss above this imbalance, the 50%, either above the imbalance or above the 50% of the imbalance, like right there, okay? Because everything is structured, right? Remember, the open, the middle, and the low. Those are the only 3 structure points. So I could put it above that 50% spot, right? Because we're taking a trade like at the beginning of this POI. Or remember, we could have turned around and used this 15-minute POI as the lower higher time frame structure. So now we get this structure break here. So it turns this into a 5-minute POI. We could have been taking shorts. Could have been taking shorts here at the mean threshold. Stop loss above this high right here, right? Targeting new lows. About that 118.10. Okay. So 118.10, targeting new lows. So this would be This would be how I approach that setup. That's a potential 1 to 6.5, which is an excellent setup. The risk to reward makes sense, right? The structure makes sense. The points, you can see it is clear. You can see this W in price, right? So there's going to be retail stops below here. So, price go there, pair their exit orders up with that. Boom, shot a beam. There you go. So, yeah, I'm going to end this here, guys. We are at that 1 hour mark. I'm going to end this training here. I'm going to give you guys the recording. I'll upload the recording to the group. And then after that, I'm going to upload it up to the YouTube. So I appreciate you guys tuning in to this training, man. I hope this really helped you guys understand like a better way to look at structure, like how to organize the time frames you're looking at, actually understand what fractal flow means on. This ain't the last time we talk about this. We'll drill on this shit until you guys get this. So I enjoy giving you guys value because like we all going to clap easy together. I appreciate you guys. I'm gonna end this video here. If you got any questions, just ask me in the group. I got something I want to ask you guys too in there, but I was just asking inside of the chat. So with that said, peace out, guys. Hope you guys enjoy. Whoever you watch it from, much love from Tradehouse, California, and we'll talk to you guys next time. Okay.